Welcome back, and this week we're coming to you from our temporary studios in Forest Hills, Queens. That's right, New York City. So if you do hear an elevated train in the background, that is the Long Island Railroad. But on to our first story. There is now a courtroom fight that is reaching far beyond two corporate giants, and it points straight to the financial well-being and also fairness for those that are seeking credit. According to new reporting from Housing Wire, a California realtor is urging a federal court to consider a question that's getting surprisingly little attention. Do private home listings that are not shown on the MLS put seniors' their home sale price at risk, even to the point of financial abuse? That is the issue that emerged in an amicus brief filed in the ongoing antitrust lawsuit that Compass launched against Zillow in June of this year. Compass argues that Zillow's listing access standards, a rule which blocks homes from Zillow if they're being publicly marketed for more than one business day before they appear on Zillow, they say it harms both Compass and competition across listing portals. The brokerage wants the court to halt the enforcement of that policy while the case proceeds. But one voice is actually trying to widen the scope of this case. Greg Alcama, an 80-year-old California realtor who filed the amicus brief earlier this week, and he argues that the debate is over off of the MLS, or listings that are not on the multiple listings service. Now, this isn't just about business models, corporate strategy, or even antitrust implications. In his view, private listing networks create what he calls a shadow marketplace, a system where fewer eyes will see a home and competition is reduced and dual agency increases. And that, he says, is especially dangerous for one group: senior homeowners who often rely on their home equity as their primary financial asset. According to Alcama, concealing a senior's listing from the broader MLS, whether intentionally or through restricted private network marketing, can suppress the ultimate sales price. And if an older homeowner sells without exposure to the open market, he argues that loss of equity could constitute elder financial abuse, or at a minimum, a breach of fiduciary duty by the listing agent. Alcama draws a line or a correlation between the listings that are not on the MLS and the real financial harm for older Americans who may not be fully aware of the implications of the limited visibility marketing. In his filing, he's asking the court to require Compass to disclose hard data of its off-MLS sales and how many homes were sold privately, how those prices compare to similar homes that were listed on the MLS, and whether consumers, especially seniors, are losing measurable equity in the process. He also wants Compass to prove that its off-MLS practices do no damage to sellers, particularly vulnerable older adults. And for now, none of that is settled. The presiding judge, Jeanette Vargas, is still weighing evidence from a 4-day hearing last month on Compass's motion for a preliminary injunction against Zillow, a ruling that is not expected for several weeks, and the court has yet to decide whether it will accept Alcama's amicus brief at all. But the broader takeaway is clear. As private listings increase, the question isn't only who controls that listing data, but whether reduced transparency will put a senior's equity and sales price at risk. And that's an issue that real estate professionals, regulators, and advocates may be forced to confront, regardless of how this lawsuit does end. It came as a surprise last week when the U.S. Department of Housing and Urban Development officially reopened the public comment period on potential updates to the federally insured home equity conversion mortgage program. Official word of this change came last Wednesday in the Federal Register, and it may signal HUD's ongoing effort to reevaluate both the HECM program and the HMBS, or HECM Mortgage-Backed Securities program. Now, HUD had first requested industry feedback in October, and it asked lenders, servicers, consumer advocates, and others that are stakeholders in the industry to weigh in on how to improve seniors' access to home equity and innovations that may strengthen the program in the future. The original comment period was closed out on December 1st, but now that has been extended until January 5th, 2026, and the agency said they will also consider late submissions when possible. Several trade groups didn't wait for the extension. The Mortgage Bankers Association submitted a series of recommendations late in November, and touched on modernizing the program, operational efficiencies, and long-term sustainability. Also, the National Reverse Mortgage Lenders Association, or NRMLA, delivered an 11-page letter to HUD and FHA outlining its priorities for program improvements. Now, since many of NRMLA's and the MBA's detailed proposals were highlighted in last week's blog post on HECMWorld, I'm going to focus on one new element that deserves attention: NRMLA's position on lifetime expectancy set-asides, or LESAs. And here's one key point of NRMLA's feedback, and it is asking for the Department of Housing and Urban Development to revisit the longstanding 75% cap on partial LESAs. And they argue that the current 75% rule serves as an overly conservative barrier that unfairly reduces a responsible borrower's available HECM proceeds without a proportional increase in safety or a reduction in risk. In other words, the cap is limiting access for qualified seniors without meaningfully improving the program's safety or outcomes. NRMLA is urging FHA to limit the 75% restriction to allow greater flexibility, including the option for borrowers to voluntarily contribute after closing to support future property charge adjustments. And as HUD has reopened its comment period, the message from industry advocates and program participants is becoming increasingly unified. The HECM program remains a vital retirement tool, but there is room for thoughtful modernization that would preserve consumer protections while reducing inefficiencies. We'll be watching for any new comments made in the Federal Register, and we'll bring you the most relevant insights and notable outtakes as HUD is compiling feedback and perhaps even signals their next steps forward. And in our last story, the cost to generate traditional or forward and reverse mortgage loans will be increasing. According to a recent Housing Wire report, mortgage lenders nationwide could see credit report costs jump as much as 50% in 2026. And these increases stem from a combination of FICO pricing changes and also new fee adjustments from all three major credit bureaus: Experian, Equifax, and TransUnion. Lenders interviewed by Housing Wire say that once all those adjustments do stack together, the total price of a tri-merge credit file could be about 43% higher than it was in 2025. For traditional lenders with large pipelines, that's a notable expense. But for reverse mortgage lenders, the higher fees will be noted in the closing cost. And if applicants do question the charge, you'll want to be able to explain the forces behind this change. Equifax responded sharply to FICO's plan to double their mortgage score pricing next year and to shift to a direct license model. And they say that is an increase that is excessive and will drive up costs for lenders and consumers alike. Now, to counter the impact, Equifax say it will make VantageScore 4.0 available to mortgage participants at roughly half the cost, about $450 per score through 2027, and in some cases at no charge through the end of 2026. The company framed that initiative as part of an effort to introduce some real competition into a market that's been long dominated by a single scoring provider. In the HECM Financial Assessment, the credit score does play a key role, or I should say the credit history, in the HECM qualification process, in that it helps to reveal a homeowner's willingness and ability to pay property taxes and homeowners insurance premiums. And that in part helps determine if a lifetime expectancy set-aside would be required. A few industry executives told Housing Wire that this new change would likely force lenders to tighten their triage processes, and private label reverse mortgage products are likely to feel the higher tri-merge cost fees. So here's the bottom line for reverse mortgage professionals. This change in credit pricing will not slow HECM lending, but it does warrant being able to explain the higher cost if you're questioned by the homeowner.